Good morning, everybody. Welcome to Cowgill's Property and Construction Sector Budget Briefing. It's 9:03 now, so we'll make a start if that's okay. We have an hour, so please do feel free to ask any questions along the way. There is a Q&A box on the top right hand side of my screen. I'm not sure where it is on yours. So if you do have any questions, please just pop those in the box there. The team will do our best to answer those along the way, but if we do run short of time, I can tackle those towards the end if that's okay. I do have a question already from Rebecca Grimshaw, so I'll answer that a little bit later, Rebecca, if that's okay. Darren, could you just pass us through to the first slide, please? So I'd like to introduce the team, everybody. Those of you that don't know me, I'm Stuart Stead. I'm a partner and head up the property and construction team at Cowgills. We overseen the various services that we provide to the sector. I'd like to just pass to James and then to Dave just to give a quick overview of their roles and what they do at Cowgills.
So I'm James Greenhalgh, one of the other partners here at Cowgills. I've worked with Stuart for 20 odd years in the tax department, just working closely with him on a lot of the property construction clients within Cowgills. I won't bore you with all the details of what I do, but it is basically advising all sorts of businesses on tax structuring, both from an owner-manager perspective and a corporate perspective. And basically help Stuart to develop the property construction team here at Cowgills alongside Dave.
Hi, I'm Dave Rainford. I'm Director of Property Funding Cowgills. So I provide advice to developers, contractors, property professionals in terms of funding, whether that is ground up, large schemes, portfolio acquisition and investment and refinance. And I also wear a hat as an MD for PMJ Capital, so we're a direct lender into the likes of lots of HMO conversions, PDR, residential acquisition. So anything to do with property and funding, that's really my bag in Cowgills.
Thanks, Dave. Normally we would invite Paul Hammond to this session. Paul's our head of VAT, but fortunately or unfortunately, there's been absolutely no changes whatsoever. So I think it was a particularly good use of Paul's time. So Paul is always available if you need any questions answering around VAT. Then could you just pass it on to the next slide, please, if that's okay. For those of you that are aware, we do have a kind of a non-sector specific budget webinar tomorrow. I think it's at 8:30. That session is intended to go into a lot more detail in terms of the technical aspects of the budget. Today is very much about us taking the bits that we believe are more relevant to the property and construction sector, chatting through the changes on those and trying to apply those changes as to how it may affect your and our day-to-day lives from a business perspective. I've chosen 4 areas out of the budget to speak about specifically, which is about the employees NI changes, CGT, inheritance tax, and then just get Dave to chat through any potential funding implications of these kind of tax increases. I'll make a start in terms of the NI costs. Very simply, it's more expensive. Obviously, it's another 1.2% for employees NI, and the threshold has been dropped. So it's going to cost everybody more money, and that's not particularly insightful, but that's the hard fact of the matter. From our perspective, we're just trying to understand how that might impact through the property and construction chain. Obviously, if we take this from a construction perspective, which then flows through to developers, it's an increased cost, and somebody somewhere has got to take that pain whether that's by way of reduced profitability for the developer, lower margin for the contractor, or ultimately that ends up with a reduced land value for the vendor in a development situation. We were just debating at this just before the start of the call whether it might push certain businesses to rethink their procurement strategy. I know construction cost management has you know, had a little bit of a resurgence, I suppose, in the last couple of years. I think D&B has been problematic in terms of a procurement strategy. There's I understand the reason why it's obviously been very popular. There's been a number of high-profile casualties in that sector, and I think a lot of that has been down to D&B and the implications of that for the contractor. So if there's a way to employ more subbies directly into your vehicle that is then undertaking that construction project, perhaps there's a little bit of a saving there to be had. My view personally is for a 1.2% increase, it's a lot of money on a big number. It's a pain, but is that likely to change a procurement strategy? I doubt it. I think it's something that we just need to understand, and Dave will chat through the kind of funding market. But my view is, it's somebody suffering is somewhere. It's just where and how that pain is taken, unfortunately. In terms of mitigation, I just passed to James now. There's only really one potential area to reduce the impact of this, which is around salary sacrifice type of arrangement. So I'll just pass over to James just to chat through that. Thanks,
Stuart. Yes, it's probably just worth reiterating that it is employers NIC, so that is the national insurance cost borne by an employer paying wages to an employed individual. So it doesn't apply to a payment to a self-employed subcontractor. But obviously, you know, developers, if you've got central staff employed on full-time, part-time contracts, you've got that NIC bill every month and it is going up. One thought we did have, we've been chatting through the last few days, is, and it's not something new, but it perhaps brings it more into focus because of the increase in payroll tax, is salary sacrifice schemes. And in very simple terms, if an employee wishes to make better pension provision for themselves, if they are coming up for a bonus or an increase in salary, or they just wish to make further pension contributions, there's a way of doing that which mitigates the employer's NIC cost. So in terms of a practical example, say you've got a high earning member of staff, who's a land agent or a part of the development team who's on a bonus arrangement for getting deals over the line, and he's on 80, 90, 100k salary per annum. If he is in line for a 10k bonus at year end, if you put in a proper salary sacrifice arrangement, and that is that you don't just do it, you actually do a formal variation to the contract or a formal variation to the bonus arrangements, and it needs to be documented between employee and employer that he sacrifices that 10k bonus, but in effect he sacrifices it, but he agrees that it's paid direct into his pension scheme. So what does that get? Well, the employer does not pay NIC on that 10k pension payment. The employee doesn't pay any employee NIC on it, and it just goes straight into the pension. So it's not applicable if they need the cash, but if they don't need all the cash, it's not an all or nothing. This, you know, it doesn't have to be the full amount. You can do salary sacrifice arrangements on any part of the salary or any part of the bonus, as long as it is implemented and put in place before that payment is made. So, you know, the revenue do look at these type of arrangements, and if you haven't implemented it correctly, they will ask for the pay as you earn and NIC. So there's a bit of admin there to do ahead of that, and more crucially, conversations with those key employees. Do you want to do this? It's not just an NIC saving. They'll obviously save the income tax on it, and for someone in that 100k bracket, you know, anything they get above 100k is taxed at 60%. And now you're thinking, hold on a minute, I thought the top rate of tax was 45%. Well, it is if you earn above 150k per annum. But where you earn in this, I hesitate to use the word sweet spot, between 100 and 125k, the Treasury in their wisdom, they withdraw your tax-free personal allowance. And what that does is the combined effect of that and the fact of the higher rate tax coming in at 125k, that means there is an effective rate of tax on that band of earnings between 100k and 125k of 60%. So any salary sacrifice arrangements in that band of income are, you know, it's a high rate of tax relief that you're getting. So I would encourage, you know, even owner managers, you know, looking at pension provision. That was one of the plus points of the budget, actually, one of the few. They didn't monkey about with the 60k pension allowance. Anybody can put 60k a year into a pension as long as they've got earnings of that amount. So I would encourage you to use that. You know, you can bring forward relief from unused relief from earlier years. So it is one of the few ways to actually mitigate the effects of this increase and get a bit of a tax saving for the employees and the employers. It's not getting cash into their hands, but it is increasing that pension provision, which is as a boring accountant, you know, it is good to plan long term.
Okay. James, so just rolling through to the second point around capital gains tax and VAT, or as we call it. Obviously, the tax team have had kind of a flurry of activity before the end of October in terms of business sales, in anticipation of a hike. Obviously, it's gone up by 4% from a general kind of position. Obviously, the residential rates haven't changed as far as I'm aware. So, but I'm thinking more in terms of exits of businesses, particularly construction businesses, or winding up businesses once the development has obviously come to an end. There was a where for many years of kind of winding up those individual SPVs and attracting kind of capital gains tax rates. We're just chatting through, if you don't mind, the current landscape on those changes, and it might be well worth reiterating the rules around kind of targeted anti-avoidance stuff around winding up SPVs as well, just for background context.
There's still an opportunity there. It's perhaps worth just going back to what the position was pre-budget and then noting through the changes. So pre-budget, back in April, pre-election, Jeremy Hunt reduced the capital gains tax on residential properties. So if you hold a residential property as an investment, so a lot of people, you know, even if they're developers, they do hold stuff that they've built up over the years just from deals where, you know, properties have been acquired, not sold. You know, so if you hold it personally, you would have been paying 28% capital gains tax. That changed back in April down to 24%. Now, the main rate of capital gains tax, if you sell shares in limited companies, that for many years had been 20%. I'll come on to the business asset disposal relief position in a minute, but the main rate was 20%. So what Rachel Reeves has done is to equalise those two rates. The main rate of capital gains tax is now 24%. same as the residential property rates. So you sell residential property for a gain, you sell shares in a limited company for a gain. The baseline, what you're going to pay is 24%. Now, in the context of business disposals, this is where it is unchanged at present, but it will be changing in April next year and in the following year. So pre-budget, there was something called the lifetime allowance of £1 million, and that's where if you made disposals of shares in a business or a business carried on as a sole trade or a partnership, and by business, and this is where it normally gets interesting for property, it can't include investment businesses. So if you have a business of letting out properties, be they commercial or residential, you are never going to qualify for business asset disposal relief, because that is and always has been classed as an investment. We're talking here about businesses where you physically develop properties to resell, or you provide construction services, or any other myriad of other, wraparound services in the P&C sector, surveyors, planners, all that sort of stuff. If you traded through a limited company or as a partnership, if you sold that business, the first £1 million, you could claim a 10% capital gains tax rate, as long as you've been trading for a couple of years and you're either a director, partner, or the sole trader in that business. So that has not changed overnight from last Wednesday, but so there is still an opportunity to do that. And coming on to Stuart's point, if you had a special purpose vehicle that had traded for a couple of years, developing a property, there was potentially an opportunity to access business asset disposal relief on a formal liquidation, a solvent liquidation of the company, not just take the money out and strike it off at company's house. It's appointing, a formal insolvency practitioner who basically puts a notice in the London Gazette to say, are there any creditors knocking about? And then the shareholders get their money. So that opportunity was there. There've been some rules around that have been brought in back in 2016 to tighten up the rules, that you couldn't just do it in a serial way on each of your mirror image SPVs. That opportunity is still there till April. So anybody disposing of a business between now and April will, if they've not used up that £1 million lifetime allowance, still be able to access that. From April, disposals after that, after the 5th of April, the 10% is then going up to 14%, and then in 2026 it is going to 18%. So that sort of brings us on to, and allied with the inheritance tax changes that we'll come on to, it does bring about probably more conversations that people, especially in owner-managed businesses, need to have a think about succession planning, because there's an opportunity there, particularly for MBOs in the next couple of years, to try and access some of those lower capital gains tax rates. You don't have to pay cash on day one. You can get a valuation of the company on an earnings basis and get an agreed equity valuation of the company and lock in some of those tax rates, because they are going up, and particularly for the business asset disposal relief for the 24%. If you've used all your allowance up, that's it. It is 24%. Not as bad as some of us feared, but it is still taxing inflationary gains. If you've held a business for 20 years, the cost of your capital in that business 20 years ago has been eroded by inflation, but you're being taxed at 24% on that inflationary gain. So it's not great, but it's not as bad as we feared. Do you want me to go on to the inheritance tax, Stu, or do you want?
Yeah, if you don't mind, just providing an overview as the changes that have, that are kind of coming in into play, James, and I've got some kind of thoughts as to how all this kind of knits together and impacts on succession planning, as you say. So if you can chat through the basics, that'd be great. Again,
from a property and construction perspective, the inheritance tax change is a lot of publicity. Obviously, Jeremy Clarkson's been popping up. He's not happy. That's agricultural property relief, but in effect, it's treated the same. So again, it's probably useful if I just give a quick overview of what those reliefs were that everybody's now jumping up and down about them being restricted. And in essence, they've been around 40, 50 years. And if you had a farming business or a trading business, and that comes back to my definition of what business asset disposal relief was. If you had a trading business that wasn't investment based or wasn't substantially an investment business, you could have some investments in it, but as long as it didn't tip over 50%, you were within the scope of a relief called business property relief. And that basically said that if someone dies and they own the shares in a company, or again as a partner or a sole trader that was a business and had been for 2 years, if they died in situ, the value of that business could pass to their beneficiaries free of inheritance tax. So instead of the standard 40% after, the nil rate band of 325k and the other bits that you can swap around with spouses, but assuming, that businesses were worth more than £1 million, without that relief, then 40% inheritance tax will be charged. And obviously, where you say you have a construction business that's got a 10 million turnover, maybe 800k, 1 mil profit, what's that worth? Well, there's a multiple there, not a huge amount, but that you're starting to see there on a death, how is that business going to be able to fund the payment of 40% inheritance tax? And that's why the relief was there. Now, what the changes do, and it's not coming yet, it's only coming in April 26, is that you only get it on the first million. And then after that, the effective rate is 20%. So that is still, if you've got valuable businesses, development businesses, it is going to be a problem if someone dies in situ and they have not either transferred that over or done some other planning prior to that death. And obviously, no one knows when they're going to die. So it is going to change things a lot in terms of succession planning because substantial businesses worth over £1 million are going to be looking at that. There's possible solutions on insurance policies, getting things into trust, but it's not a silver bullet. Putting stuff into trust, the trust will only have £1 million allowance itself. You can't spread it around. So there's going to be, I think, a lot of work done in the next 2-3 years, to look at the fine details, because in essence, they've announced this. There's no detailed legislation yet. It was, my view is, it was put in there to make the figures add up in the OBR forecasts, because they looked at the reliefs and they said, well, if we knock it down to £1 million, that will bring in X amount of tax, which makes the forecast add up. Now, the practicalities of how it's implemented, there will be a consultation. It's a case of, will it be a blanket approach? Will this chop and change as it goes through Parliament and various interest groups lobby? Who knows? But it is one to look at, and if it brings forward a conversation about succession planning and things like that, it could in essence be a good thing for some people, because we do find for a lot of property construction businesses, that is the last thing on people's mind. It's always, what's the next deal? We've made some money there, we put it in the next deal, we go again. And that's why it's such a sort of vibrant and interesting sector to work in. But the long-term succession planning is sometimes left too late, particularly where a development business has actually morphed from, doing things, building things, sticking stuff in the ground, to holding mature assets where you are losing the benefit of these reliefs, which are going to be carved down anyway. And there's things you can do in terms of trust planning, in terms of MBOs, things like that, that could assist in mitigating that future inheritance tax liability.
Yeah, I think for me, James, it's a fairly frightening piece of legislation or change, to be honest. I think if you particularly own a construction business, a prospect of passing early without having done any planning is you're forced to pay IHT on a value that ultimately will never get crystallised, because in most situations the owner manager of that business is the one that holds that value together. They aren't there, and then so all of a sudden you've ended up paying a huge kind of tax liability out of some other asset somewhere if you've got it. And then end up in a situation where that construction business, which quite often feeds development elsewhere as well, as the value's just been dissipated straight away. So it's it just seems completely nonsensical to me. And whether there's any changes as you say along the way as it passes through Parliament, hopefully there'll be some sort of kind of change to that. But as it stands, our kind of private client team will have a busy 18 months or so doing a bit of planning here. I've got some notes really along kind of similar lines as to what you mentioned there, James. But I wanted just to ask you a question actually about AOTs, so kind of employee ownership trust as well. I think there was a consultation launched in the budget as to the use of those. I was just wondering whether that might, there might be a swan song there in terms of before any changes are made to the AOT regime.
Yes, certainly. We've seen a few in the last few months. That, just to be clear, that's where a business is effectively sold to a trust that's for the benefit of all the employees. Now it's great for the exiting shareholder because there's a zero capital gains tax rate. The only caution I would say is that it's not for everyone, because it is quite a cumbersome structure going forwards. It's quite hard to incentivize key staff. It's all the employees sort of own it through the trust. But it can work, and it's worth exploring if someone wants to exit and has a stable business that they are willing to exit. And yes, there has been that consultation, but it's not changed yet.
Yeah, I think use of trust obviously is bound to become much more favourable over the next 18 months.
It is, but I'll just mention this sort of nightmare scenario that I was discussing with my colleagues. That we said, everybody will be putting stuff into trust in the next couple of years, in the hope of mitigating that 40% charge. Now, trusts pay inheritance tax at a rate of 6% every 10 years on the value of their assets. There's nothing to say that a future chancellor in 2, 3, 4 years' time, looking at the amount of assets in trust, wouldn't put that rate up. But I suppose if it's less than 40, you've still saved. So if you were cynical, you could be saying that the chancellor's laying a bear trap there for people to put loads of stuff into trust and then change the trust tax regime. But who knows?
Yeah, I've just noticed a question there coming from David Bay, but I should just come to in a second, David. I think one very practical thing to have a look at is just the use of insurance. I know I don't want to sound like an insurance salesman, obviously, but it's quite popular or advisable to take an insurance policy out to either wholly or partially protect against your liability to inheritance tax. I think obviously before, where you held qualifying shares in the trading business and it wasn't subject to IHT, then you didn't need to. But I think now we probably need to have a look at that, and that certainly helps in that scenario where there's a kind of untimely passing of the principal. So that is something that you need to speak to your owner, the IFAs about. So we obviously have our kind of team here at Cowgills with the Ascot Lloyd guys, but that will become much more prevalent, I think.
One thing to add on that, Stuart, is valuation.
Yeah, absolutely.
So when you are taking out an insurance policy to fund an IHT liability, you need to know what the revenues view will be of the value of the company. Now, they won't give you that, and the only way to do it is to effectively value the company as if you were going to sell it.
Yeah.
So there's in this new landscape of people trying to insure more, which I'm sure there will be, then that will need to be done alongside proper valuations, and obviously our corporate finance team at Carrigills do valuations on that basis, but I think they're going to be a lot busier in the next 2 or 3 years on those sort of internal valuations, whereby you look at it regularly every couple of years to see, is your insurance policy actually fit for purpose and the right amount, just in the same way you would on a building.
Yeah, and just the final point really for me on this particular topic is just going back to farming really in a way. Obviously, farmers own land. The changes to agricultural property relief are problematic for them. I just wondered, Dave, just as a segue, I suppose, into your kind of funding stuff, whether some farmers might be saying, do you know what, it's been tough anyway here. We're going to get hit with kind of significant HT liability moving forward, probably. Is it time to start to dispose of some of that land? Does that free up kind of opportunities in a perverse way for the property community? But I think just from a general perspective, Dave, what's your take from a non-tax person? How your clients, the PMJ clients, might look at this in terms of interpreting what's happened and how that might affect their appetite, pricing, funders' kind of view on life, if that's okay.
Yeah, I mean, a lot of what I'm going to say is probably state the obvious. I mean, this sector and funding appetite is all about confidence. But to be honest, it's just too early to tell as to what the impacts of what Rachel Reeves have done as it filtered through. I've not seen anybody sort of pull out of transactions because of an increased SDLT rate. Talked to a number of surveyors, and there is no consensus as to whether we've got any downward pressure and any aspects of values, but it is too early to tell. If you look at the OBR, interest rates are expected still to continue to fall, but not as fast as they previously predicted. So something now predicting probably a 0.25% less easing by March of next year. And there's now some concerns of the inflationary pressure of the fiscal loosening and spending. To me, there's a lot of elements of words and figures differ in this budget. Lots of positive promises in terms of government spending and investment into housing, the affordable homes programme, etc., etc. But the government's to the target now to deliver whatever it is, £1.5 million homes is in many people's views at risk because of the increase in employers' NI. And the view is from many now that will hinder the industry to recruit and train new staff because they won't be spending as much in those areas. And that then obviously wider implications in terms of next generation of skilled workers. We're still waiting, what is going to happen in terms of planning reform. And we've had this sort of throwaway £46 million of additional funding to support recruitment into planning authorities. But in England, and I did Google this, there's I think 337 planning authorities. So that's about £150,000 for each authority. So that's against, as we all know, a background of chronic historic underinvestment in planning authorities, under-resourcing, and to me, it's just a drop in the ocean. And that investment is going in without any checks and balances, without any targets or performance criteria. So it'll just end up going into a black hole like a lot of government spending does. No other business would put investment in somewhere and then not have any performance criteria. I'm not going to sort of bang on about planning, but it does come back to proper reform with proper targets and decoupling politics and planning. But that's a whole other big issue. So on stamp duty, the point of that was to on the basis that the majority of second homes are owned by private landlords and occupied by private renters. So the idea of that was to try and provide first-time buyers with more of a level playing field or a competitive advantage in terms of buying properties. But then you look on the other side, and the SDLT threshold is going to return to normal or previous levels in April. So that to me is a bit of a known goal, because I think Zoopla said that there's currently about 80% of first-time buyers that don't pay any stamp duty. They expect that, or estimating that, will fall to about 60%. So there's no joined up thinking there to me. Also, that additional charge may act as a disincentive for would-be landlords to enter the market. It may discourage others to expand. There's also the argument to say, well, a 2% stamp duty is really that a massive amount in the whole scheme of things. But then you look at how that may feed through to the supply of new homes. Will that impact on rents for tenants, i.e. a rise in rents? And obviously those tenants are likely to be working people. So somebody who doesn't want to hit working people potentially will do. So those are sort of my views on the sentiments coming out of this. In terms of funding, it's all down to appetite and confidence. Too early to tell. Stuart mentioned moves to from D&B to construction cost management. I'll be honest. I think a lot of funders, for reasons that we can not so difficult to assess, for reasons because of how very difficult for funders to assess the quality and strength, covenant strength of a main contractor. Will it still be around in 12, 18 months? We've seen the casualties in the market. So funders aren't adverse to going down the construction management route. The things that then dictate that are the experience of the developer, the experience of the professional team, but also higher contingencies in development appraisals.
And Dave, for I think I alluded to this before, but for 1.2%, is it worth a hassle?
Exactly. Yeah. But I think developers do see potential, irrespective of whether we're talking about the measures introduced by the budget. I still think there's probably an increasing trend of going down that route, because we're seeing tenders coming back. Contractors, rightly or wrongly, are building in fat in terms of those tenders, and whilst material cost rises, think have softened a bit, there's still issues around that there. And then we come back to NI increases, resourcing, shortage of skilled workers, that they are just pushing up prices generally in the marketplace.
Are the funders having a slightly different view then, Dave, in terms of, because obviously at one time they wanted a kind of rock solid D&B contract in place, given all those high profile failures? Are they more accepting now of?
I think they are, and I think that is because of what you said. We've seen failures. Any construction lawyer will always know that there's no such thing as a fixed price contract. There'll always be disputes, there'll always be arguments, there'll always be prelim costs in there. And historically, unless we're talking about some of the very, very substantial contractors out there who, for the majority of the clients that I sort of deal with, you wouldn't even be asking them to put on a tender list. Contractors' balance sheet strengths are always very, very subjective. The historic, nobody really has a feel for what else is going on within that contractor. And hence, if the borrower's got the experience and can surround themselves with a good professional team, I'm seeing more and more people going down that route.
Yeah, plus the bond market is a lot tighter as well, isn't it? So...
Yeah, you can't. Yeah, bonds are difficult. You can't get bonds. But I'm seeing, very, very few funders now will look at an appraisal and get away with much less than a 10% contingency. So contingencies have risen over the past 12, 18 months.
Thanks,
and scrutiny over build costs, because the only downside then through construction management or from a self-build scheme is appraisal pound per square foot costs are always going to be cheaper through self-delivery than through a main contractor. So there are elements of subjectivity there as to whether funders, I mean, I've seen some funders increase contingencies to 15% because of that, but that will always be a subjective assessment based on the developer's experience, previous schemes, and professional team.
Yeah, great. Thanks for that, Dave. Well, just leads us into questions now, really. We do have one there from Steve. Yeah, it's probably for you. Just asking if there's been any stamp duty changes to a commercial property in the budget.
Yeah, so Dave helpfully explained, the changes to stamp duty. Just to be clear, it's on residential property. So, buy-to-let investors or people buying more than one, or already holding more than one house, buying an additional house, are going to pay an additional rate of stamp duty on residential properties. So Steve's asking, are there any changes for commercial property? The answer is no. But it is worth pointing out that where an investor buys 6 or more residential properties in one transaction, then you can access commercial rates of stamp duty on that. So instead of paying these inflated residential rates, if you buy 6 or more residential properties, you're not going to be paying more than 5% as long as you elect for that treatment. So it's something that lawyers do sometimes miss, where you're buying a big a batch of residential properties for investment or for resale. You should just be paying the commercial rates on that.
James, a question that I've had from a couple of clients already is, does the additional 2% kind of SDLT apply just to straightforward corporate acquisitions of a residential property?
Yeah.
And it does, yeah.
The only way to get out of it is if you are buying it as your main home, and at that point in time you've sold your previous main home, or you don't own any other property.
Okay. Good. As obviously the Q&A box is open there, everybody. If you do have any more questions, please, this is the time really to pop those in there. Let's give it a few seconds to see if that's the case or not. I mentioned we do have our kind of overarching Cowgills budget webinar in the morning. So if you do want an invitation to that, please just feel free to drop either Dave, James, or I your details. I'm not seeing anything pop through there on the questions, so I'd just like to thank everybody for their time this morning. It's very much appreciated. As always, if there's anything that you want to discuss, please just pick the phone up, drop us an email. More than happy just to chat through anything that we discussed today, or indeed that kind of comes out of the detailed review of our budget note or the webinar tomorrow. I do hope that you found it useful, just to put some of this into context, and we'll look forward to seeing you at our next event. Thank you very much.